So we just got the unemployment rate report, and non-farm payrolls was expected to come in at 150K, and it beat by like 70%. Came in at 254K. Now this is the official numbers. I am not saying they're wrong by any means. What I am saying is that 16 out of the past 19 months have been revised, so we gotta wait for revisions. The June number got revised down from 200K down to 150K to 100K. And also, it's like everyone forgot already that in the past year, right, this is back in August, they reported this, when they did revisions to the non-farm payrolls, it got revised down by 818,000. So always keep this in mind when you're looking at this number right here, because yeah, it seems like the economy is booming, right, based on this number. Um, yeah, we'll have to wait and see, because they just revised by 818,000 2 months ago, right? Also, the official unemployment rate number, this gets revised in December of every year. Um, Now, what I want to do is I want to go back and look at projections for the unemployment rate back in October of 2007, right? So we can see right here, if we scroll down and you can see the date, right? October 31st, 2007. The unemployment rate was, and this is the Fed's projections, right? The unemployment rate was expected to go up to 4.8 only in 2007, and then stay at 4.8 to 4.9 in 2008 and 2009, right? And 2010. So just to put it into perspective, this was the Fed's projection, right? And then that's what actually happened. Okay. Now I wrote here, changed their mind in 2009. So the red line for the peak unemployment. What I mean by that is this: in 2008, in the global financial crisis, so this is a month or two into the recession, their unemployment rate forecast uh, went slightly up, right? But 5.3 was the P for 2009, right? So we're going to put a ceiling here at 5.3. So this is what the Fed thought back then. So what do they think right now? The exact same thing. They think it's just going to go sideways here. So this is the Fed's projection for 2025 and 2026. This is what tends to happen in reality, okay? Now, the unemployment rate went down, we had a pullback, and we also had a pullback last month. Now, last month, you need to look at the decimals. It went from 4.25 to 4.22. This month, it actually went down to 4.05. So that's gone down 0.2% now in total. Now, 86% of the non-farm payroll job growth came from the government and not the private sector. So always keep that in mind, because that could include someone working part-time for 2 hours a week for the government, or for example, with the non-farm payroll numbers, if you have 3 jobs because you need multiple jobs to keep up with inflation, then all of a sudden that counts as, even if you have 3 jobs, that counts as multiple jobs in non-farm payrolls. But again, when the US recessions have begun in the past, we've had pullbacks. It's not like it's random to have a pullback in the recession. You know, it happens, right? Didn't happen here, didn't happen here, but it happened others and others. It happened here as well, right? Was it different this time when it went down here? No. Was it different right here when it down here when it went down here twice? No. And you can even see here if I mouse over this. This is in December of 2007. So the recession began here, December to January 2007. We had one pullback in the recession. We had another pullback in the recession, and for about 5 months, from December of 2007 till April 2008, the unemployment rate pretty much went sideways inside of the recession. So it's not unusual to get a pullback like this. Now, where this time would be different is if this continues going down, okay? Because it has to head back up if we're going into recession, okay? Now, if you look at the 2 year and the 10 year, we can see that the 2 year went up 6% today, or rather the change, right, was 6%, but it went up by 20 basis points and 22 basis points, and the 10 year went up by 12 basis points. And in this case, I actually posted about this on Twitter initially. It's not actually very steepening because the yield curve went back towards inversion. It's not inverted again, but it went back towards inversion, as you can see here, right? There was a pullback in the yield curve, right? And this is because the 2 year is going up faster than the 10 year, right? Now, people seem to forget that this is a very weird thing for short-term interest rates to yield more than long-term interest rates, right? Now, where it would be a sign from the bond market that it's different this time is if the 10-year climbs more than the 2-year. Okay? This just means something is slightly delayed by the bond market's interpretation. My opinion does not matter. I'm just telling you what the bond market is telling you based off the price action. This right here is just the delta between the 10-year and the 2-year, right? The 10-year yield minus the 2-year yield. Okay. So we can even just do this here, and you can see if I change the color of this, the orange line in this case, the orange line is the 2-year yield, which is a short-term interest rate, and the purple line is the 10-year yield. Now, if you look at October of last year, why did the yield curve go up right here? Well, it went up because the purple line started to catch up with the orange line, right? This right here is bear steepening. It's where the long end of the yield curve re-steepens faster than the front end of the yield curve. Whereas right here we have had bull steepening, where you can see the orange line has gone down faster than the purple line. That is bull steepening, which is how it came out of inversion here. Bull steepening is the recession signal. Bear steepening is growth and inflationary expectations. Now both interest rates are going up here briefly, but as I said before in a previous video, if we just go and look at what's happening with the 2-year yield, yeah, it's having a nice little move up here. But this is exactly what happened at the exact same time last time, right? You can see this move so far on the 2-year has been from 3.5 up to 3.9, right? So a 40 basis point increase in the 2-year yield. And here we went from 3.8 up to 4.2. So that's a 40 basis point increase in the 2-year yield as well. So unless the 2-year yield keeps rising a lot, right, then it's the exact same as over here. It was this last little move up you had before this collapsed down, right? And again, like I posted in my last video as well, the S&P 500 topped on October 11th, right? So we can, again, you can see it right here. It topped on October 11th, and it was right here at this exact point, right? Which is exactly right here. And you can see this move was coming exactly at the exact same time. It's the exact same thing, quite literally, right? Now, I wrote down some things I had to go over. Yeah, so one thing regarding the unemployment rate, because people look at this and they go like, yeah, but the COVID spike was really bad, right? The COVID spike was very bad because it went higher than at any point here, and it was the highest unemployment rate since the Great Depression, right? That is true. But if you just do something as simple as overlay a moving average, and I'm gonna explain why I'm doing this, okay? Moving average. Let me change some settings here. Um, let's make it a 150. Yeah, 150 moving average, 150 month moving average. Okay, so you can see, let's not do 150, let's do 80. Yeah, this is a better sign. Okay, so the reason why we care about the moving average is because think about it logically. If you are living paycheck to paycheck, like most Americans are, 66% of Americans live paycheck to paycheck. 50% of Americans making 100K or more living paycheck to paycheck, and 1/3 of people making 150K or more are living paycheck to paycheck. And they're drowning in credit card debt and they have pretty much no savings. Then what happens if they lose their income, as in because they lose their job, and they can't get their job back? Well, they're forced to capitulate out of assets, in this case, real estate and or equities, right? So a higher unemployment rate, the reason I'm bringing up the moving average is because here you can see how the unemployment rate remained high. Whereas here it went higher, but it came instantly back down. So the moving average barely went up. This matters because this does not lead to the same amount of forced selling as something like this does, okay? Whenever the moving average is extremely high, it's normally a catastrophe for the economy, right? So that's one thing to keep in mind, and that's really important for um, understanding if assets are going to come down or not. I was going to go over QE I wrote down. I guess I could. So there has been, because again, we're going to get into a point where the Fed will engage in QE again. And as they did here with QE1 in November 2008, where they bought $600 billion of mortgage-backed securities and treasuries and treasury notes. That was when the S&P 500 was here, and it was in late November, which is right here. And you can see the S&P 500 went down 25% from that point, right? And then QE 700 billion Fed in March of 2020. We had something similar as well. I have to go to the daily. Actually, even go to this chart. In March of 2020, we had the exact same thing, where the market goes down initially during QE. So they had the emergency meeting. An emergency move Sunday, the Federal Reserve announced it's dropping its benchmark interest rate to zero and launching a new round of quantitative easing, March 15th. Now the stock market is not going to open on weekends, so this is March 13th. And then the day that the stock market opens, you can see from the moment they announced QE, 18% down. So in this example, 18% down when QE was announced. In this case, 25% down when QE was announced. And then we have to look at the Nikkei, because Bank of Japan did something similar and they were the first central bank to engage in QE. And what I mean by that is on March 19th, 2001, which is right here, the stock market still fell 42% after the Bank of Japan introduced QE from March 19th, 2001 until March 2006. They had negative interest rates in 1999, right? And they were buying stocks. So like literally the dream scenario for bulls, right? Where the central bank is helping them as much as possible. And from that point, which would be right here, till the 2009 lows, the Nikkei index still fell 47% for another 8 years until bottoming here in March 2009, right? After already being down by 66%. So in this case, the stock market is down 66%. They begin QE, they have negative interest rates, they're buying stocks, literally, and the stock market still goes down 50% more. So always keep that in mind with QE and the history of QE. And also, don't take it from me, my opinion does not matter. But the Bank of Japan had for many years, and as late as February 2001, stated that quantitative easing is not effective and rejected its use for monetary policy. Because as I've said before, there's a difference between QE and stimulus checks. If you do QE, you're buying treasuries and mortgage-backed securities from the banks and the non-bank entities. If you're going out on the open market and buying treasuries from the non-bank entities, meaning people like me who have treasuries, if the Fed goes in and buys it, am I likely to go out and spend that and stimulate, for example, Apple's earnings by buying a new iPhone? Probably not, right? What am I more likely to do? I'm more likely to go and buy assets. Okay, so if I go and buy assets, what does that do? It causes inflation, but it's not consumer price inflation, it's asset price inflation. Okay, so always keep that in mind. There's a big difference between that, between QE and stimulus checks, and that's why they said that it was ineffective, right? The Bank of Japan. What else? Let's see. But I keep this in mind as well, and with the June number as well for the non-farm payrolls, it got revised from 200k to 150k to 100k. And yeah, they revised August up now, but 16 out of 19 months have been revised down, so always keep that in mind. And it was government employment primarily, not private sector employment. In regards to inflation, because we can see TLT is down, which I'm bullish on, right? This goes down if there is growth in inflationary expectations in this case, because then long-term interest rates will rise, right? Now, my belief, as I've said before, is that I believe this is what's going to happen to TLT. I believe we'll see 115 to 125 in 2025, and that will be because of disinflation and deflation. This is my belief. And the reaction to the deflation will be a new CARES Act 2.0, which is stimulus checks and massive QE, but this will cause inflation again in 2027, 2028, probably, and TLT will front run it like it did in 2020 and 2021. Because overall we didn't have inflation, but the bond market knew that it was coming. So we started pricing it in, and then when we got inflation, it was down bad, right? And TLT went down 55%. Okay. I will get out of TLT based on one or two conditions. Something gets cheap and I want to buy it. So I sell my TLT to get liquidity to buy. 115 to 125 is my target because I believe long-term interest rates are in an uptrend now because we made a higher high for the first time in 40 years since 1980. And since TLT is mechanically 100% inversely correlated to long-term interest rates, the 20-year yield in this case, I'm bearish on TLT when we get the next bailout. Okay, because that's going to send the long end of the yield curve really high. I believe, I mean, just look at the chart, right? We were in a downtrend since 1980, right? Downtrend since 1980. And then what did we just do? We made a higher high for the first time in 40 years. And what's interesting about this is this began in 1980 and we're now in 2024. And if you look at the Nikkei index, what did they have? They had 40 years of insane growth, right? This began around 1950 and it went on till 1990. And you can see how much their stock market went up, and then it went nowhere. It's still sideways since 1990. Another thing I want to bring up is people think that because again, when it comes to TLT, people go, well, it's going to go down because we're going to see more inflation. Well, it depends on what your belief is. My belief, again, based on what I've posted on Twitter, it's quite simple. It is the M2 money supply that causes inflation. That's because of history, right? When the black line goes up, you get the inflation with a lag, which is the red line. Happened in 1940s and happened in 1970s. I don't think this is the same as this or this or this. Okay, I believe we'll see inflation eventually, but I don't think it's now. Okay. Now, a lot of people talk about the deficit spending, and the deficit spending is going to cause inflation. Well, let me show you something. First, let me show you with China, and then after I'll show you with Japan. Okay, because China is the second largest economy in the world. Japan used to be the third largest. Now it's Germany that's the third largest, but Japan is number four now. But back in the 1990s, Japan was number three. Okay, so the reason why I'm bringing this up right here is because what I'm going to do is I'm going to overlay the CNM2, so the Chinese money supply. And when I'm also this, you're going to see the valuation here, okay? So at the peak here in the stock market in 2007 in October, it was there were 39.4 trillion currency units in circulation, okay, in the M2, in the Chinese M2 money supply. And over today we have 305 trillion. So let's do the math on that. 39.4, right? So in this case, 3,940. Zoom in slightly. 3,940, whatever, this is good enough, all the way up to 30,500. That's a 670% increase in the M2 money supply in China since then. And what has happened to their stock market? It's down 30% in nominal terms. And what about the inflation? CN, I think, yeah, this is the ticker. All right. So what we're going to do is we're going to overlay the moving average and we're going to do the same thought experiment again. So this is the peak in the stock market, as you can see here. If I overlay the Hang Seng index, right there, that's the peak in the stock market. And since then, what's happened to their inflation rate? Well, all we have to do is we have to overlay a moving average, just like we did before on unemployment rate. And then we change this to, let's try 80. Yeah, and you can see what the average inflation rate since then has been. It's been around since 2007, probably around 2.5% or so, because it was slightly above this. 2.5% inflation, even though they have had a 607% increase in the M2 money supply since 2007. You would expect the inflation number overall to be higher, right? But that's not been the case. So why is that? And it's been the same thing in Japan, because Japan has the highest debt to GDP in the world. I think it's 260% or something. And the US is 120, 130%. So it's twice as bad as in the US, right? In Japan. So everyone talking about deficit spending causing inflation, all that, right? Well, let's look at what happened in Japan, because in Japan, we have had, what is the ticker? JPRYY, since 1990. The reason why I can't overlay the money supply is because it's not accurate on TradingView. I don't. It's because of the way Japan reports their numbers. So overlaying the money supply is not going to give you an accurate representation of the amount of currency units in circulation. It's definitely a lot more than what TradingView says, which is a 200% increase since 1990 or whatever. It's not the case. What I mean by that is this: JPM2. Just look at this. Over here it said there was 440 trillion currency units here, 1.2 quadrillion. So 3x since 1990. I can guarantee you that's not the case. There is way more yen in circulation since then. But their national debt has exploded. And their debt to GDP is twice as bad as in the US. Now we do the same thing here. We overlay a moving average since 1990 and we make it 80. And then we go to the monthly. Okay. And you can see on average what has the inflation rate been in Japan. Well, any inflation here, the orange line, right? The purple line being neutral, anything below is deflation, anything above is inflation. The green line is the central bank's target at 2%, and any inflation gets wiped out by brief deflation, right? So you can see the moving average here has led to pretty much they've had no inflation in the past 25 years or so. Since 1990, maybe the overall inflation rate has been 0.5% a year since 1990. But how is that possible if they have such a high debt to GDP? Because the argument is that deficit spending is what's going to cause inflation, all that. then why hasn't Japan seen that? And this is the problem with the argument that I never understood with, oh, the deficit spending is what's going to cause inflation. Then why is inflation coming down? Again, I'm not saying the cumulative effect is that's not going to go away, but I'm talking about the inflation rate year over year. Why is that not exploding? And the reason why I believe it's not is because everything has to do with the M2 money supply. It's not just the increase in the money supply either, as you've seen in China, because if people get stuck in a deflationary mindset, you go into a deflationary spiral where it's hard to get out of it. You can give people money as much as you want, but if they don't go out and spend it, it's not going to cause inflation. Okay. Another thing I wanted to go over was with the Fed funds rate. Give me one sec. Fed funds rate. So we know that actually I tweeted about this somewhere here. Yeah, no, that's not the one. Uh, it is here. Powell, no need to go fast on rate cuts if economy evolves as expected. That would mean two more cuts this year for a total of 50 basis points. What's funny about that is that would match 2007 exactly too, because we know that on September 18, 2007, they kept by 50 basis points, just like the exact same date, but 2024, but the exact same amount. And now, two more total 50 basis points, 25, 25, the rest of the year. That's the exact same as 2007. So no difference at all, right? And if you think the Fed is in control, again, this is Ben Bernanke. He said this at the inauguration. When I was at the Fed, I occasionally observed that monetary policy is 98% talk, only 2% action. The ability to shape market reputations of future policy through public statements is one of the most powerful tools the Fed has. The downside for policymakers, of course, is the cost of sending the wrong message, and that can be high. Presumably, that's why my predecessor, Alan Greenspan, once told a Senate committee that is, as a central banker, he had learned to mumble with great incoherence. Right? So why should we care about what the Fed has to say? And again, the guy who got a Nobel Prize for not inventing but beginning QE in the US and causing asset price inflation literally says himself that they're irrelevant. And again, just like I went over in the beginning of this video, this is their projection, and this is what tends to play out right here in reality, right, based on all previous examples, once the unemployment rate goes up this much. Okay. So keep that in mind. What else was I gonna go over? Yeah, so I'm not gonna be the one to sit here and say that the numbers were fake or anything from the non-farm payroll numbers, because that's just coping, right? It's a good sign, right? If things are better than what we think, right? But the problem is I have a couple of reasons to doubt it, and one being they already admitted to lying about 818,000 non-farm payroll numbers in the past 12 months. And it's probably worse. It's just what they were admitting to, right? What is on average? That's a lot of jobs, right? That they're lying about. Um, Also, I'm just using logic now. I'm not saying this is what's going to happen. I'm just saying there would be incentive, multiple incentives for them to lie about it. Why? Because as we know, there's bearish divergence here on the S&P 500. What does it tell you? People are getting out. Well, how do the rich people get out of their Ponzi scheme? Well, they have to do it with a great narrative. They need exit liquidity, right? Because for them to get out, someone else has to get in and absorb their position, right? Their selling pressure. So it's a great sign, right? Not a great sign. It's a good way to distribute to the people who don't know what's going on in the charts, right? With a great narrative. That's what I meant to say. And the next thing being the elections. Now, I'm not saying that this is the case. I'm just saying that it's weird that 16 out of 19 months have been revised lower, and right before the elections, we beat the expectations by 70% to the upside all of a sudden. That's all I'm saying. I'm not saying they're fake. They could very well be true. But I think just reading the headline number and saying that, oh, well, that's great. Uh, well, maybe you forgot about the revisions that it did to the non-farm payroll numbers. So I'd be very careful with that. And especially since 86% of the jobs that were created was from the government. Um, Also, like I mentioned, in December of this year, we're gonna get revisions for each state individually and the national unemployment rate. So we're gonna have to wait and see in December. But I think the next 3 to 6 months are gonna be very telling. Whatever happens to the unemployment rate in the next 3 to 6 months will tell us if this time is different or not. Now, I don't think it's different. One more thing, because I want to provide both perspectives, right? And also, just one more thing here. Market share, all funds. Look at the trend here in active versus passive. Active in orange and passive in blue. This guy asked me, what's wrong with passively managed funds? It's a sign that there is no analysis. Just throw money monthly paycheck into the Ponzi because number keeps going up. A literal textbook Ponzi scheme, right? Where you get paid from by early investors get paid from later investments to create an illusion of big profits. It's not actual um, earnings growth, right? But yeah, that creates a bubble, and if they all burst, these people who had no analysis are likely to capitulate. But this is the one I wanted to bring up for the perspective, right? For both perspectives, just so if you are one of those that think it's going to be different this time, then here's a chart for you. Some rule trigger dates an unemployment rate trend. Normally it goes up, this time it's gone down. Okay, so if you think it's different, well, here's a chart for you. I'm not gonna sit here and have a bias in the video. Yeah, I think it's more probable that we have a very, very bad hard landing, but I'm gonna provide this data for you regardless. Um, yeah, I think that's all I wanted to go for this one. And even I raised the eyebrow to this jobs report. So I think there's a psychological reaction amongst market participants to buy the top, right? And that's a perfect exit liquidity type of situation, given the fact that the chart is telling us it's about to roll over based on the bearish divergences. That does not have to result in a crash, but this looks toppy. I'm just talking about technicals. Okay. All right. Also, pay attention to the decimals. And U6 went down from 7.9 to 7.7, but we're just back to where we were in July with getting the June data, but getting it in early July. So 3 months ago was were things different all of a sudden? No, not really. So keep that in mind. All right. That's all. Take care. Peace.